Welcome back to the channel. QQQ has been the undisputed leader of growth investing for well over a decade, benefiting from a perfect storm of innovation, falling interest rates, and the explosive rise of mega-cap technology companies that now dominate the global economy change. However, as we move into 2026, the environment that once made QQQ so powerful is beginning to change. Valuations are far more stretched than they were in previous cycles. Market leadership has become increasingly concentrated in just a handful of stocks, and investors are starting to rotate toward areas with stronger momentum, better diversification, or exposure to emerging technologies and international markets. While QQQ remains a high-quality, long-term ETF, its heavy reliance on the Magnificent Seven means that even a period of sideways consolidation or underperformance from those names could significantly drag on overall returns. This opens the door for alternative ETFs, particularly those focused on semiconductors, momentum strategies, advanced computing, or international equities, to potentially outperform in 2026 by capturing broader participation, faster-moving trends, and sectors that are earlier in their growth cycles. In other words, QQQ doesn't need to fail for it to be dethroned. It simply needs a year where leadership broadens, capital rotates, and investors begin rewarding flexibility and diversification over sheer size and past. QQQ has been the dominant force in growth investing for many years, largely because it was positioned perfectly at the center of some of the most powerful trends in modern market history. The rise of big tech, the shift toward digital platforms, cloud computing, and years of ultra-accommodative monetary policy that rewarded large, scalable companies. That combination allowed the biggest names in the NASDAQ 100 to compound at extraordinary rates, pushing QQQ to returns that few ETFs could match. However, heading into 2026, the market backdrop looks very different. Interest rates are no longer near zero. Valuations across mega-cap tech are significantly higher than their historical averages, and an increasing share of QQQ's performance is dependent on a very small group of stocks continuing to execute flawlessly. When an ETF becomes this top-heavy, the risk is not necessarily a crash, but a long period of underperformance, where gains become harder to achieve because expectations are already so high. At the same time, markets naturally evolve and rotate. Leadership rarely stays concentrated in the same names forever, and we are already seeing signs that investors are beginning to explore opportunities outside of the traditional QQQ trade. Areas like semiconductors, momentum-based strategies, and next-generation technologies, such as AI infrastructure and quantum computing, are attracting capital because they offer more direct exposure to growth drivers rather than indirect exposure through mature megacaps. In addition, international developed markets are starting to show renewed strength as valuations remain more reasonable and economic momentum improves outside the U.S. These shifts matter because ETFs that focus on momentum, sector specialization, or global diversification can adapt more quickly to where capital is actually flowing, instead of remaining anchored to yesterday's winners. What makes 2026 especially interesting is that QQQ does not need to collapse for other ETFs to outperform it. Even a year of modest, single-digit returns from mega-cap tech could be enough for more flexible, more targeted ETFs to pull ahead. If leadership broadens, if smaller and mid-cap innovators begin to outperform, or if international markets continue their rebound, QQQ's structure may limit its upside relative to funds that rotate winners, concentrate on high-growth niches, or intentionally avoid overcrowded trades. For long-term investors, this doesn't mean abandoning QQQ altogether, but it does suggest that the next phase of the market may reward diversification, adaptability, and exposure to emerging trends more than simple size and brand dominance. In that kind of environment, the king doesn't fall dramatically. It simply gets outpaced by faster, more agile competitors. Thanks for watching and subscribe. See you to the next video.